Hello, welcome back to Reflections on Investing with the Cornell Capital Group. It's been a while since we've done a Reflections, but I think we have an interesting one for you today. One thing there's been a lot of discussion about is so-called buying the dips. Whenever the stock market falls significantly, it's a buying opportunity because it's going to bounce back. And you can think for a minute, buying the dips could be a self-fulfilling prophecy. If people buy on the dips because they think they're going to make money, their purchases will cause stock prices to rise. And if that is seen to be successful, then more people may want to try to buy the dips, and it may become, as I said, a self-fulfilling prophecy. But is this really an effect, or is this just the financial media picking up on a few isolated examples and talking about it as a general rule? So here at the Cornell Capital Group, we always like to go back to the data and test the idea. So here's what we did. We downloaded all the S&P 500 index levels from July of 1962 until the present. So a little over 60 years of daily data. And as you can see on the chart, it shows the total days, which is over 15,000, the up days, which is just about half. In fact, it's 51%. And we asked if in those 15,000 plus days there's a big down day, is there a bounce back? Now you have to define that precisely. So the way we did it, we said, okay, let's call a big drop. Let's start with 1%. So if the market drops more than 1% on a given day, is it more likely than not to be up the next day? In other words, to bounce back somewhat, to have a positive return. Now, efficient markets would say the odds are 50-50. Whether it went up yesterday, it's still about 50-50 to go up today. But the buy the dips would say no, it's more likely to be up. So let's turn to the results. And it's shown here in the table, starting with the minus 1% drop. Of the 15,000 plus days in our sample, there were 1,668 days where the market dropped at least 1%. And on those days, it bounced back 49.4% of the time, almost exactly 50%. Not much to write home about, consistent with efficient markets. Well, maybe the drop wasn't big enough. So what the table shows is we checked for drops of at least 2%, 3%, 4%, and 5%. And the results are intriguing. When there's a 2% drop, the bounce back is 54% the next day. Still awfully close to a half, but more than a half now. At 3%, it's 58. At 4%, it's 67. And we're talking about a significant deviation from 50%. But of course, there were only 51 days in that 60-year plus period where the drop was more than 4%. And finally, where the drop was more than 5%, we're down to 26 days, but 81% of the time, the next day was positive. So it does look like when there are very large drops, there is a bounce back. Now, you can't tell from this whether it's enough to make trying to buy the dips a worthwhile investment strategy. That would require more work. But it is interesting that following large drops, the next day is up over 2/3 of the time. So we hope you enjoyed this short video. If you're interested in this type of data or in the spreadsheet we used to produce this table, just get in touch with the Cornell Capital Group and we'll be glad to give you the information. This has been Reflections on Investing. Thanks for joining us.